This is the Value Investor Podcast with Tracey. All things value, all the time.
Welcome back, value investors. So this is the last Value Investor Podcast of 2025. How quickly this year has gone, and we've covered a lot of topics on the Value Investor Podcast. But I wanted to cover another important one as we're heading into the new year. This is the time when I normally do like what has worked or what should you look for in 2026. And so I'm going to concentrate on how you can find the best value stocks for 2026. But I even ran into some difficulty in trying to find the best value stocks for 2026. So I decided to turn it into this podcast. And what that means is I was thinking, I'll just run some screens there and, do the podcast. But it wasn't that easy because growth is in, value is out. And yes, there's plenty of cheap stocks out there right now because there's plenty that have sold off here in 2025. But remember, cheap doesn't necessarily mean value. And a lot of those are value traps as those earnings estimates have been cut and the earnings are on the decline. And that's what we try to avoid. We want cheap stocks, but we want the stocks with rising earnings if we can get it. And so that becomes a little more difficult when you're trying to screen for that scenario because we don't have a screen that's just, please screen for real value stocks and not value traps. Thank you. We don't have that. So I had to make do and I had to try a bunch. So the first one I ran with was high ranked values. And those it seems common sense, right? It's high ranked and it's a value stock. This had price to earnings and price to book as the value. It has, the high rank of 1 and 2s. And I ran that one and I got 127 stocks. So I was a little surprised by that. Like, what? Why are there so many high ranked value stocks? And then I scroll through the list and because it has the price to book in there, what industry has the low price to books right now, which actually is indicating value, which we've talked about at several times this year and every year, is the banks. So there were dozens of banks in this screen because of the combination of the PE and the price to book being so low. So I didn't really want that. And I couldn't really parse out what wasn't a financial on this list. So I just ditched it and went on to the next one. So the second one I ran was undervalued Zacks number 1 ranked stocks. That sounds common too, right? How difficult could that be? So what did it look for value? PE under 20, price to sales ratio on this one of 1 or less. Obviously, we always look for 1 or less on the value investor because that indicates we're getting the sales for cheaper. We're going to get, if the price to sales is 0.7, we're getting the dollars worth of sales for 70 cents. That's what we want. That's really cheap. And these were all number 1s. So I ran this one and I got 28 matches. Well, that was more in our wheelhouse. It also did not have the price to book. So I knew that the banks mostly weren't going to be in this screen. And that was good because I didn't really want the banks here for 2026. We have talked about them. I've done whole podcasts about the banks. I do still love them for 2026, but I wanted to do something outside of the banks on this podcast. And what did this give me, though? It gave me a lot of the traps. I'm not going to lie. They do have the number 1 rank, right? So how does that reconcile itself? They are strong buys, but the strong buy just indicates that the analysts have recently revised their earnings estimates higher. And all of them are in agreement. So probably nobody is cutting their earnings estimates. They're revising them higher, but that doesn't mean everything else is totally going well underneath that. That just means maybe the analysts were being too conservative with what was happening at that company. So while I love getting the Zacks #1 ranks because it does indicate rising earnings estimates, on the trap issue, it doesn't always capture that aspect, the underlying business and what's going on there. It does mean the analysts are getting more bullish, but it might not be for the industry. So what were some examples on this and why I actually rejected this screen as well? So Kohl's was in here, Lazy Boy, that's a furniture retailer, and a Pollo Loco restaurant chain. I'm trying to stay away from the retail right now because the consumer is just in a very bad mood. And while some retailers are doing better than others, some restaurants are doing better than others, it's just not an area I really want to go into for 2026 because there's a lot of uncertainty there and things could get better. And we might not be in a recession next year, but it could get worse. So we did just have the November consumer sentiment came in at its lowest since 1970, which is kind of hard to believe. I think it was like 50.4. And I say it's hard to believe because we've had the Great Recession. People were pretty down on their luck during that time period. So this is even lower than that. That's very low. So I'm trying to stay away from those retailers who maybe the analysts thought, things were real bad, but now they're not going to be as bad going into 2026. But I don't want as bad. I want things are going to be good, or, they're really turning it around. So I rejected this for that reason, because this had a lot of stocks that I felt were very trappy. So what are the industries where there are a lot of traps? Well, retail, the restaurants, like I just mentioned, chemicals, home builders. It is not looking good. Those margins are being cut again. We did just recently hear from Lennar and KB Home on the earnings reports, and both of them talked about the headwinds. Both of them are guiding for lower sales for this upcoming fiscal year, lower deliveries of the homes. They're trying to get rid of excess inventory. Price cuts are happening. They both have great amount of cash on hand, so that's not an issue for them. They're just going to wait out this cycle. But I don't really need to be owning the home builders while those earnings estimates are being cut. So I own Toll Brothers in Zacks Value Investor. The luxury side is holding up a little bit better, and so are their margins. And I own that in my own personal portfolio, but would I buy it now? I would probably be on the sidelines, kind of waiting to see what happens in 2026, and especially in that spring home buying period. So we'll see on the home builders, but for right now, they're traps. And then another big area that's a trap is energy. Those estimates are still being cut. We recently had WTI at its lowest in 4 years, or almost 5 years now, but since 2021. And a lot of people think it's going to go lower in 2026. Who knows? Usually when everyone is on one side of the trade, it doesn't happen. But it's still a struggle. Anything under $60 for the energy, the oil companies, that is difficult for them. Natural gas is higher, though. So if you're looking around, you might want to consider natural gas. And then we have the electrical, the power guys, and that is doing well. So oil is where I'm looking for traps right now. So those are some of the trappy areas. So where are the values? Well, I mentioned one, and the one I really do like for 2026, the smaller banks, the regional banks and the small banks. They are very undervalued, and you get the good dividend with many of them. And they are being totally ignored. Nobody cares. And so I like those. I like the areas where they're being ignored, but those earnings estimates are on the rise at most of those smaller banks. So take a look at those. And then the other area that I have mentioned in the past as well on the podcast, gold and silver miners. We're still at record highs in both as I'm recording this on December 19th. And it's been a record or close to it for most of this quarter for the miners. So I'm expecting record free cash flows again, but you got to get it out of the ground. Keep that in mind. You could also buy the ETFs that capture a bunch of them. So if one or two of them is having trouble getting it out of the ground, the others can make up for that. So keep that in mind, but those are true values. And the ranks look good because as gold or silver keeps rising, so will the earnings. So the analysts keep revising higher on those. And yes, they've had a big run, gold and silver, obviously here in 2025, but I'm still bullish for 2026 on both of those. Okay, so that's some of the values and the traps, but this isn't helping us with the screen. How do we find a screen that covers some of this? I could just screen for gold and silver miners and the small banks, which I have done, but I want something outside of those areas. Aren't there any other values that aren't, retail and these other things? So I ran small caps with big growth because I do want that growth component. I can't just look for value alone. And this one does have a value component to it, even though it says with big growth. So it does look for the value in the price to sales ratio. Again, it's less than 1, just like undervalued Zacks number 1 ranked stocks. But it doesn't have the PE in this one, just price to sales, which I'm good with on a screen because price to sales is a very strong value indicator. And you can go it alone with just the price to sales ratio. This one also, last close has to be over $5. That's just for the close. Market cap, less than $1 billion. That's what they determined is small caps, which I'm somewhat in agreement. Sometimes I go up to $2 billion these days because everybody's bigger, it seems. But this screen's still under $1 billion, so true small caps. And average volume over 100,000 shares. This year, the growth rate has to be greater than 20%. And then it does throw in the Zacks rank, number 1s or number 2s, the buys and the strong buys. We want those. And it gave me 17 matches. And this one was a more eclectic group. So I did go with this screen. So the growth component is really the missing piece that I was looking for in some of these other just pure value screens versus a value screen that also has this nice growth component. Now on Zacks.com, if you're looking at the premium screens, there are 8 value screens that are pre-made just in there for you. So the first 2 I talked about were under those. Then if you're not a premium member, but you can look at the basic screens on Zacks.com as well. Those are free and available to everyone. There were 3 value screens in the basic screens that looked for, it didn't actually come out and say like this is a value screen, but you could tell it was because it was searching for things like PEG, low PEG ratio, and PE and things like that. So this gives you 11 screens if you do both the basic and the premium. That's a pretty good amount. Those are just the value ones. And then you have these other ones where you can search by market cap, which is where the small cap one came from. There's growth and income. There's some momentum screens. There's some themes. So there's a lot of choice, and try to look beyond the value if it's not giving you what you think you want. And sometimes you don't know and you just want the cheap stocks. So the 2 that I was talking about are fine. But you can see the particulars with them and why, we got too many banks with one. And then the other one, we got too many value traps like retailers and whatnot. But small caps with big growth is the winner on our final podcast of the year. So I picked out 3 out of the 17, and these are kind of interesting ones. And they might not be all that you think when you're thinking about 2026, but there's small caps, and those are always very difficult, right? Because not as much is written about it, not as much analysts on them. You're not seeing them on Bloomberg, on CNBC, on Fox Business. Nobody's really YouTubing on them. And I could be the very first person to podcast on these 3 companies. But as value investors, we try to find the hidden stocks, the ones that no one's paying attention to. And that is really these. So let's dive right in with the first stock. It's VSTS Corporation, ticker V as in Victor, S as in Sam, T as in Tom, S as in Sam. VSTS, VSTS. And they do uniforms and workplace supplies. That has been a hot area, but really in the market leader, Cintas. And so VSTS has had a little bit more difficulty, especially this year. The estimates have been cut and have come way down, but how did it get its number 2 by ranking? Have been revised higher in recent weeks. Remember, the Zacks rank is a short-term recommendation, 1 to 3 months. And usually you get those changes after the last earnings report, either up or down. Something better is going on, so the analysts have to revise higher, or whoops, some kind of headwinds, and they revise lower. But usually you see the most changes to the Zacks rank in earnings season. So we got the number 2 because those earnings estimates are being revised higher. And just taking a look, 2 are higher for this fiscal year in the last 30 days and 1 for next year. They're now looking for 37 cents a share for this year versus 19. So that's a big increase. And then next year, 57 cents a share. So this year, they're expected to grow earnings by 48%, and then next fiscal year by 52%. Revenue is on the decline, though, down 2.9% expected for this year, and then up 1.9% for next year. Now, they did talk about in their last earnings report, which was their 4th quarter 2025 on December 1st, and that was for the period ending October 3rd. So they're already into fiscal 2026 now. But they did talk about a multi-year and increasing profitability and cash flow. Their plan is for cost savings of $75 million by the end of this fiscal year. In that last quarter, revenue did decline 3.5%. There was an extra week in the quarter, but if you take that out, it was a revenue decline. Free cash flow was $15.6 million in Q4. And here's where you have the issue, though, and I know some of you won't like VSTS for this reason. Total debt outstanding was $1.34 billion, including principal bank debt outstanding of $1.17 billion. This year, I said the earnings growth, 48%, market cap of $909 million. So this is on the bigger side of these small caps. Year to date, the shares are down 54.3%. Like I said, they've really sold off this year. So it's unclear if the street is really buying the multi-year transformation aspect. Price to sales ratio is just 0.3. So that's really cheap. You are getting the sales really cheap. PE on this one is 18.6. So not super cheap on the PE basis. But the shares have rallied in recent months off the lows. And this is a stock under 10, so it's going to be very volatile. Keep all these things in mind. But you get volatility with small caps. That's just how it works. So you might want to keep it on your short list and see what they're up to and if they can turn it around. So that's VSTS Corporation, ticker VSTS. Okay, going on to stock number 2. We might have talked about this one. INGN is the name of the company, ticker INGN. INGN. N as in Nancy, G as in George, N as in Nancy. And it's a leading global technology company with innovative respiratory products for use in the home care setting. Their last earnings report was third quarter. So they're on the regular year in November, and they saw the 7th consecutive quarter of mid-single-digit revenue growth. They're tiny, 184 million for INGN. Earnings expected to be up 40.7% with a price to sales ratio of just 0.5. So we know it's going to be under 1 because that's what we screen for, but 0.5 is very cheap. It's a number 2 buy stock. And even for next year, 2026, looking for another great earnings year of 37.8%. So the street, though, is rejecting it. As I said, year to date, shares are down 26%, but it really hasn't gone anywhere in a couple of years. But let me look at, we only have one analyst covering this. So because it is so tiny, but we do have that one analyst. It is losing money. It only has expected to have a loss of 90 cents this year, but a loss of just 50 years. So it is moving in the right direction. And that's what I like to see, especially to avoid that trappiness issue. I don't want to see the earnings expected to decline for next year. I do want to see the growth there. On the revenue side, expected to see 6% this year and 10% for next year. So that's nice revenue growth there. So this is a stock that has sold off since October. So it's cheaper than ever. And again, it's just very difficult to own stocks under $10. This is another one. It's trading at $6.71, but it's got good growth trajectory. And it's got the Zacks number rank 2 because the one analyst on it has been raising, let's see, they raised in the last 60 days because they did report in November, so it's been a while. And it did go to a loss of 90 from a loss of 95. So they are a little more bullish on what's going on at INGN. So keep this one on your watch list as well for 2026. INGN is the ticker. And then the third one is in the financial area, and it's Redwood Trust, ticker RWT. R as in Robert, W, T as in Tom. And this one has a market cap of 713 million, so a bit bigger. And you won't believe what this one does. Well, if you were around in the financial crisis, you might be like, what? Why would you buy this? But this is now, this isn't then. So they purchase mortgages from lenders, and that allows the lenders to recycle their capital and make more loans. So they do have a 30-year track record of providing this liquidity to the housing market, and they provide it to segments of the U.S. housing market that is not well served by the government programs. So that might mean like jumbo loans, for instance. It issues mortgage-backed securities, which is backed by private capital. The last quarter was a record quarter, 5.1 billion of locked loans. They do pay a dividend, and I don't, let me see. They did have a very high yield. Right now on Zacks, it's showing 12.4% as the yield, or 72 cents. They did pay 18 cents per share, unchanged from the third quarter in the fourth quarter. So it's not one of those that looks like real variable in the dividend. And that was the company's 106th consecutive quarterly dividend. So they have been very consistent. What else do we need to know? Shares are down 12.4% year to date, but so not as much as some of the others. But when you look at the 5-year chart, the shares really peaked in 2021, and then the Fed started cutting rates. Nobody was getting the mortgages, and the housing market, fell into a recession in 2022, and so did shares of Redwood Trust. They collapsed down, and they've been in this kind of range under $10 for several years now. But again, this is why we're value investors, because we start to poke around where not be, because they're thinking, oh, the housing market, it's in this terrible place. There's not as many sales right now. And next year will probably be somewhat challenged, but doesn't mean some of these companies can't, have good results, let's say. So this is in the growth screen. What kind of growth are we expecting here? So for this year, 51.9% on the earnings growth side. And then for 2026, another 17.7%. So those are both very solid numbers. On the revenue, this is a revenue decline this year. Last year, they made $102 million. This year, expecting $80.9 million. So that's a decline of 21%. But next year, jumping back up again to $127 million. That's a gain of 57% and well over 2 years ago then, of which was 102, as I mentioned. So that's what I like to see. We actually have two estimates on it for the year. Both of those are up in the last 60 days because their report was further out as well. They're on the regular calendar, it looks like. 9 cents is up from 54 cents 60 days ago. And then we have the 93 for next year, 93 cents, up from 77. So the analysts were being too conservative here. And so they've changed that. And that's what we want to see from these smaller cap companies. Now, maybe you do have to start looking around in some of these areas where you think, no, that's where I don't want to be. But we have been in a housing recession for almost going on 3 years now. And sales, while low for sure, are not going to stay low for forever, especially in 2026 if the federal government starts doing some kind of incentives or programs to get people to buy homes again. Then, a company like this that's doing the mortgages and giving liquidity out there to some of the markets that otherwise might not have had it could see, some good returns there. So PE is 7.3. That's dirt cheap. Anything under 10 is cheap. Price to sales is 0.6. So everything fits into the screen that we did. And you are getting this dividend that usually I would say anything over 10% you should drill down into, but they are very proud that they've paid something for 106 consecutive quarters. So that tells you they are very shareholder friendly because they're proud of their track record and they know they basically have to pay something to keep you all around during the dark times, especially. So keep that in mind with Redwood Trust, ticker RWT for that one. So you can see these are interesting companies, all in different areas and industries, and none of them are banks, even though we did have one that is a financial, but all of them are down on the year. All of them are being ignored. They all have good Zacks ranks. Redwood Trust is a 2 as well. So keep that in mind when you are looking. But remember, you could have a good Zacks rank and still have some of that trappiness in there. So it's always difficult with these small caps, but historically, small caps are the better performing of the market caps. It just hasn't been true for basically about the last 10 years, maybe a little longer. But eventually it will be. And this is where you can find the opportunities and where value investors really do shine in finding some of these smaller companies that no one else is paying attention to that might be growing their earnings by 40 or 50%. So it's worth drilling down into and at least keeping them on your watch list as we head into the new year. And then maybe in the new year, I will do a screen that's the large cap stocks with growth and value to see what comes up there. And I'm not sure how I'll get rid of the banks out of that screen. But if we can get some interesting names that are non-banks in that one, I would be interested in that screen as well. So that's the end of 2025 for me here on the Value Investor Podcast, but we will be back in 2026. And I always lead off the new year with classic value stocks. And we'll be taking a look at last year's classic value stocks that we talked about in the very first episode in January to see how did they do for the year. We're going to look back and we're going to have new classic value stocks to buy for 2026 because we do it every year and we like to see how are these dirt cheap stocks faring every year. And I'd like to also thank everybody who's been tuning in on YouTube and on Apple all throughout the years. And all the years we've been doing the Value Investor portfolio or the Value Investor podcast here. Thank you for subscribing and tuning in, sending me your questions and concerns about value stocks. There's a lot going on. 2026 will be the year that Warren Buffett steps down as CEO from Berkshire Hathaway. We'll be covering a lot of Berkshire Hathaway news, I think, next year to see what goes on without Warren Buffett at Berkshire Hathaway. So be sure to tune in, subscribe to us somewhere, have a happy new year, and I'll be back in 2026 with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.